Okay, I'm requesting an audio check. You guys can hear me? It should be showing, well, you should be receiving audio. I'm checking my Twitter. You guys give me an audio check. Tian, thank you. I just want to get one more person to confirm they got audio from me before I continue. Yay, alright. Now that I've thoroughly wasted my voice today, 3 hours, man. Somebody needs to smack my ass around. I should have checked it. I really should have, but it is what it is. Alright, so I'm going to try to do my very best to condense the 45-minute rant I opened up with. So I'm going to try to condense that into like 10 or 15 minutes, and it's going to be very difficult for me, but it is what it is. We'll try to do the best we can. Obviously, you can see the menu here. We have a few things to discuss, but I can tell you that we won't be discussing everything. So I'm going to take it up to about 3:15 my time, which is a little over an hour, and then we'll have to do part 2 of this presentation tomorrow as well. So like I said, we're going to be presenting all week until I get all of Market Maker 12 out into your hot little hands. So I have a list of things I went through rather very well, actually. I was very pleased with the presentation. I really was pissed off when I saw that there was no sound, so I'm more pissed off than you are, let's just put it that way. Alright, before we get into it, the things that you're going to learn in this set is highly proprietary, and it is things that I'm really not supposed to share with you, but I am. So I know some of you that are listening to me are going to take this information and try to repackage it and sell it, and I just want to tell you up front, you're an asshole. So just letting you know that if you just put the time into learning it, you'll make so much more money trading it than you would selling it and trying to be a smart Forex teacher. Okay, so I can tell you from personal experience, being a profitable Forex trader is a lot better than a Forex teacher. So I'll just leave it at that. I want to open up with an idea that was shared with me from my background, and I wish there was a way for me to communicate a secondary source, but I can't because it was given to me on a face-to-face daily basis, and because I'm not supposed to share it with you, I got to do certain things to keep it from resembling as best I can what was given to me. So I have to work within a medium of price action and use things to describe a very close proximity to the concepts that are used in algorithmic trading. And what you're going to see is proof in the pudding. I mean, it's not like I'm form-fitting anything. Everything I'm going to show you, you can go back into your own charts and go forward doing it, which is important because it's not one of these things is cherry-picked. Okay, everything that I'm going to show you, you're going to do immediately right after this presentation. You can go back into your charts, and I promise you, you're going to shit your pants. It's going to be amazing how often you see this reoccurring. And before I get into it, I just need one more audio check just to make sure I'm going, because I do not want to lose. Audio check one last time. Echo Bravo. And while we're waiting for confirmation from someone on Twitter, This is an unedited version, so the more professional grade presentation will be on my on my website at theinnercircletrader.com tutorial page. It's a rather lengthy delay, and okay, good. Thank you very much. All right, so I opened up the last presentation, which was just shy of 3 hours long, talking to my friggin' self. But the opening of the session I did last was I was using the U.S. Swiss here as an example on the ICT Market Maker Collection content. Okay, and while I do not trade the Swissy, it presented an ideal condition to showcase some of the things that you'll learn and you'll adopt in your mindset as a trader. And it's going to embody the idea that I'm going to teach open here is the market efficiency paradigm. And what that means is, and first of all, what is it? It's a departure from retail-minded thoughts on the marketplace, trading, and speculation. Every one of us come into this with a very excited state of mind where we're going to make money, we're going to feel validated, we're going to feel significant, we're going to be impressive to our spouses or our in-laws and all that such. And quickly we learn that we're nowhere near up to snuff and prepared for some of the things that we're going to encounter in trading. And the emotional and psychological effects of having money at risk, regardless of how much money it is such a huge barrier. Because what you're trying to do is you're trying to compete with the absolute best of the best in this industry. Okay, and that means the banks. Okay, now while you're not trading trade for trade with the banks, okay, you are trading the price that is ultimately fed by the central bank. So every bit of our price feeds are a repackaged, if you will, some slight deviations which are permitted by law in the delivery of what comes directly from the central bank. If we go into the marketplace looking at things with a retail mindset, we are going to lose money. It's a guarantee it's going to lose money. To have a market efficiency paradigm shift in your mindset, for you to be able to see things as you should, you have to look at things 180 degrees from what the retail world sees. Okay, and I took a lot of you that have been with me for a long period of time through a long journey through a lot of the common retail stuff, only to build your familiarity with the fact that these things are believed upon as the last bastion of hope for free enterprise and trading. It's the answer. It's the panacea of knowing when to buy and sell. And I'm referring to indicators and such. And you quickly, like I did, learn that it's all bullshit. None of it works. Okay, when it does work, it's only because it's lined up with what I'm about to show you. Okay, and before I even get into all this, I want you to understand what I'm showing you here today. Okay, I did not invent this. This was taught to me from people that do this, and I'm talking way above the pay grade I'm at. Okay, and I have done my best to take it away from the very thing that was shown to me, but it gets very close to what I was taught. Okay, so I'm hoping, I'm wagering, if you will. I have a lot of anxiety and honesty about sharing this because I'm not supposed to be doing it. So I want you to take that to heart. So when you guys get out here and you start repackaging it and saying, it's this, that, and the other thing, just remember, if I get tapped on the shoulder, your asses will probably get tapped too. So I'm just letting you know. So the issue is a lot of the things that you're going to see is proprietary to me. Okay, I've adopted things that I learned from the institutional side of trading, and it goes well beyond what has been commonly passed around as institutional level trading or order flow or things of that nature. well beyond it, and you're going to see that today. If you were watching the presentation prior to the one we're doing now, unfortunately it's going to steal a lot of the thunder because you've pretty much seen what I was going after, but you didn't have any of the dialogue of what it is I was trying to explain. So hopefully you'll be surprised, obviously, to what you're able to do once you understand what we're going to share. So anyway, the market efficiency paradigm is something you're going to have to experience that, okay? And it comes by way of looking at price, studying it with the idea that if you had a remote control over price action, okay, and I'm speaking in very simple concepts that may or may not be practical, but it's going to help me communicate the thought process behind it, because I have to bridge a very large gap from where I came from and where we are presently, and not get myself in trouble talking about the things that I know. Okay, so give me some latitude here with this. But assume for a moment you had control over price, and you could control price up or down, all day long. It's in your control. If you could do that, would it not be in your best interest to try to take as many people as you possibly could and put them on the opposite side of your trade, and then run the market the opposite direction to take them to a position either they're going to get squeezed out by margin, or they're going to be squeezed out to a stop loss, or hold them into something that they just think there's going to turn around, and then make a larger gap of where they started with their equity and where it would be after they collapse the trade in a severe loss. Clearly, it would be advantageous for someone that could do that. Now, there's a lot of reputable teachers out there that will probably hear this message and probably watch this entire set and disagree strongly with everything I'm going to talk about. But with all due respect, it is what it is. And I'm doing it without apology, because this is really what it's all about. The market's not about supply and demand as much as it's proposed to be by other mentors and teachers. I do not teach or trade supply and demand, and you hear me say that all the time. And today's session will just be one more evidence to that fact, because what I teach is time and price. The banks trade with an algorithmic price delivery feed. In other words, it's going to come directly from the central bank, okay, and then it gets broken down into other smaller banks which pass that price around and try to make deals on top of it just like anyone else. The source is always the central bank. They're the storehouse. They make the cut as far as the open, the high, the low, the close. They make that price, okay? They are the marketplace. So it's not a hard analogy if you understand. If you were a business owner and say you owned a shoe store, and my question is, if you owned a shoe store, who sets the hours of operation? Well, you do. I mean, you could sell shoes in the middle of the night if you wanted to, but most won't. But you set the hours of operation. Now, my next question would be, who sets the price of those shoes that's being sold in that store? And clearly we would both agree, hopefully, that you as the owner set that price. Okay? So it's not hard to grasp the central truth of it all is the central bank is the storehouse. They own the currency. It's theirs. It's an invention. Okay? It's not even a real thing. It's just an idea. Money is nothing but a perceived value. You believe the thing that you have in your wallet or your checkbook, okay, has value. But it's only based on belief. There's nothing tangible to the value that we associate to money, except for the central banks that institute it. So therefore, commerce is made through the exchange of it. Okay? The central bank, because it sets the price, okay, it is in control of price. Okay? Price is controlled, so therefore the markets are controlled. Now, a lot of folks will argue and say that the market itself is too big to be manipulated and controlled, and they're full of shit. They have no idea what they're talking about. They are not wealthy. They're not affluent. They don't have a trade. They have no idea what the hell they're talking about. Or they've subscribed to the thought process so long that they cannot bear to acknowledge the truth that this is an absolute manipulated, rigged system. And once you understand it, it's sobering. It's nothing to be fearful of, and it's nothing to be afraid of. It doesn't cause a reason for you to be upset to the degree where you get anxiety attacks being in the marketplace. Okay, that only comes by way of over leveraging. Okay, and that's understandable. You should feel that. But for you to have a paradigm shift, okay, and to understand market efficiency as it really is, okay, and again, there's a lot of reputable teachers out there that they come really close, but I'm going to get to the point. This is absolutely 100% rigged. And I've said it before, it's not shocking to some of you, but this market is rigged. And they all are. Every asset class is. If it trades at a price, it's all rigged. It's manipulated. Okay? And this is the biggest business there is. I mean, this is the market of all markets. It's money. I mean, we trade stocks for what? Money. We trade commodities for what? Money. Options, money. Futures, money. Index, money. So where are we at? We're trading money. Okay? If there's any market out there that's going to be manipulated, it's going to be this one. So if you, as the storehouse, okay, selling shoes, if you made that shoe yourself too, you have a complete control of everything. Of inventory, of how it's delivered, when it's delivered. You control the quote-unquote supply and demand factors of that shoe or shoes. So as the central bank, as the storehouse of currencies, okay, they are in the business of selling money. They supply that money. The money supply is them. They create the market. So without them, we can't do what we do. So it's important that I'm not trying to vilify the central banks. I actually am very appreciative of their existence because it's really prevented me from having a very pauper's life. I live a very blessed life, and I'm very thankful for that. And the opportunities that are available once you understand what they do, while yes, some of it can be looked upon in I guess the word I'm looking for is some of the things that goes on along the banking sector is a little disgusting, and admittedly, but everything can be taken to a degree of obscene if given enough opportunity to do it. So without going into a longer rant and making this the same repeat 45-minute rant that I didn't get across in the audio of the first presentation, why is this market efficiency paradigm helpful? Okay, well, first you have to look at the marketplace with the intent that there's somebody out there that wants to upset the cart and take you out of positions or put you in positions that are not profitable. And the way they do that is they manipulate price, and central banks do that. Now, I know some of you will say, "Oh, the central banks wouldn't do that, and they're not trading against you," and yada yada yada. Yeah, they are. Okay, trust me, there is opportunity in that, and they do it. Okay, they're doing it's such a huge corrupted thing. Okay, they're in control of it all, absolutely in control of it all. And once you understand their game plan, okay, and how they work their business model, every single day there's a trading opportunity. Now, while I don't trade every single day, once you learn what I'm going to share today, you will find a trade setup every single trading day. Every single one of them. You'll have a setup that you could, if you're sitting in front of your charts, if you know what I'm sharing with you today, you will find a setup every single trading day. And it will not have any basis on Fibonacci. It will not have anything with moving averages, pivots, supply and demand, none of that stuff. It's all going to be, it's just going to be specifically dealing with time and price, because it's going to be leaning heavily on how the interbank algos work. Okay, and believe me, no one else is teaching this shit, so pull up a chair, get ready. Retail thinks the market is based on a lot of good bets. Okay, a lot of good trades. A lot of trades sit out there. Okay, and when we look at uneducated money, okay, dumb money, street money, okay, there's a lot of it out there. Lots of it out there. Just look at the forums. Look on Twitter. Okay. You'll find that there's a lot of willing participants out there that just want to lose their money. Now, they're not coming into the marketplace with that intent, but invariably they come into the marketplace just like lambs and they get slaughtered. They collectively, okay, the speculative uninformed money, they most of the time have no awareness of smart money. They don't even acknowledge that there's an existing entity that is deemed smart money. They just think there's lucky traders and there's unlucky traders, and they're hoping they're going to be lucky. They don't believe that there's a way to systematically take this market apart, okay, and see how it really works, and therefore develop an edge with that. They believe that indicators will give them the insight that they're looking for, and therefore deposit money in their account. We all learn quickly that that's bullshit and that never works. So when we look at the crowd, okay, that collectively is referred to in this diagram of speculative uninformed money, it's rather large compared to the small little circle I've been diagram that's smart money. And I did that to show this paradigm that needs to take place, because if we are participants of the group on the speculative uninformed money, okay, we are willing or unwilling liquidity. Now, what I mean by that is we're willing to be providing liquidity in the marketplace by our trade being in the marketplace with a stop loss. Okay? That same trader is also an unwilling form of liquidity. He doesn't want, or she doesn't want to lose her money. What's the difference between those two people, or two position type trader in an uninformed group? One acknowledges that they're unwilling. The other one is oblivious. They're both uninformed. Okay? They're in the marketplace with no reason to be in there. They're gambling. Okay? So when we are in that group and we don't know what smart money is and how they operate, because it's become a buzzword since 2010. It caught fire. Smart money this and smart money that. It was made a big deal. Like everyone knew what smart money was doing. And supposedly VSA was teaching what smart money's doing, and supposedly just the COT was teaching what smart money was doing, and all that stuff falls short. You're going to know what smart money does today. Today, when this presentation's over, you're going to know exactly what smart money does on a day-to-day basis. Now, do not equate that to taking a trade every single day. I don't trade every day. There's just certain things that I look for, that I like to have specific criteria, and I'm actually going to tell you that today. If you want to trade every single day, you can. Nothing's stopping you. I'm just telling you as a mentor, don't. If you want to get in your practice with the demo account, great, do that. It's good education, it's good experience, but don't go in here trying to risk money every single day, because even though what I'm sharing with you today, I believe is the brass tacks of price action and how we decipher the algorithmic models that are used at the central bank level, you'll be able to see exactly what you should be doing as a trader well ahead. I already know what I'm going to do in October. I already know what I'm going to do next April. I already know what I'm going to do. It's so systematic. Your trading will be just like that once you fully digest what I'm sharing with you today. Okay? Contrast the mindset of having the uninformed money perspective, okay, hoping there's a lot of, like when we first sit down in the marketplace as a new trader, we have no idea. We read a couple books, put a couple indicators up there. Some guy says this is what you do. When this crosses this, you buy it. When this crosses that, you sell it. All of a sudden, we get in there and we have, man, there's going to be 50 trades this week I'm going to be able to get. I'm going to be killing it this week. That's the mindset. Whether you admit it or not, that's exactly what you were thinking when you first came in. Contrast that with smart money. Smart money does not look at, there's going to be 50 trades this week, yada, 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 in a euro. They're not doing that. They are methodically, systematically engineering specific conditions in the marketplace that only occur a couple times a week. Now, you can fine-tune that down to smaller, little, tiny little movements of price action, okay? But the ones that really make a significant impact in terms of, for instance, the weekly range, those are only a couple a week. But if we're going to specifically deal with day trading, which is really what these next two sessions are going to be dealing with, specific only day trading, and being able to get in there precise and know exactly what the banks are doing, what the banks are going to allow with their price, when's they're going to enter a sell program, when's they're going to go into a buy program, when to anticipate that, what to do with it, where to place your stop at, all that business, okay? Do not look at that MyFX book and assume that that's how I trade. Okay, I do a lot of stuff online for my own personal entertainment, and I'll leave that up to you whether or not it's something that's I should be doing, but I entertain myself with that. What I show you today This is how I trade. This is how you'll see me trade. This is how you should trade. Okay? That's the only advice you're ever going to get from me. Is if you understand this, this is how you should do it. Period. Okay? But if you're in the smart money group, or if you're aspiring to be in that small little circle of smart money, okay, look at the paradigm shift that takes place. The uninformed money has little to no acknowledgement of smart money. They have no idea what it was. I thought Larry Williams was smart money when I first started. He's not smart money. He's just a trader that got real fortunate in a lot of moves, and he admits by his own words, he's not a good trader. He's not a good trader. Okay, so if you look at the smart money group, they view the uninformed money as a very big opportunity base. There's lots of them. There's lots of opportunity to instill the wrong crowd at the wrong time in specific markets. The market efficiency paradigm is smart money spends its time engineering price action to facilitate this uninformed crowd to get into the marketplace, and they spread them across the entire spectrum of asset classes in their interest, not the uninformed interest. See, when we get into trading, we think this is the greatest thing in the world. We're going to be able to quit our jobs. We're going to be able to take our kids on dream vacations, buy our spouses jewelry that they don't really, deserve, in my opinion. Because I think jewelry is the biggest waste of money. Unless just watches, I like watches, but jewelry and rings and such, I think that's a waste of money. But I am a sucker for a good timepiece, so it is what it is. The smart money spends its time engineering and crafting ways to almost lead, like a leash, individuals to participate in the marketplace and give them a false sense of hope, thinking that there's opportunity here to make money. Now, I know this is going to go challenged by a lot of folks listening, but I'm telling you, after seeing this today, and especially what we show tomorrow, you're going to know beyond a shadow of a doubt that this is absolutely rigged, and there's a way to exploit it. And there's nothing to fear about them changing the game plan, because there's so many suckers coming in every single day. Like I said, I could put this on the USA Today, just change a couple things so I can't get myself in trouble. But nonetheless, I could put it in the newspaper, and largely, no one will pay attention. And in fact, that's all part of what I do online. I put up so much chaff. I only want folks that did the work to see the value in it. The ones that are actually doing the work, they know when I'm up here pulling charades on the internet, they know what I'm doing. I'm having fun with it. But the people who are doing the work with it, they are seeing the light. They know exactly what's going on in the marketplace. They know what's going on. They don't care what I'm doing online, and neither should you. When you put your work behind studying what I'm going to share today, you will have this paradigm shift in your market thought processes. You'll leave that retail thinking, okay, and you'll adopt smart money. See, retail thinks, like I said, there's a lot of trades. It's all good bets. Okay, lots of them every single day. But the smart money sees very selective points of trade. Very selective. Okay, they're not in there every single minute, every little tick. They're not doing that. Okay, but they are strategy-based, moving price to specific levels to engineer liquidity, put people in the marketplace that weren't in the marketplace at all. Okay, maybe that didn't even had an interest. But if they drive price real quick, think about it. If you have a real quiet market, okay, for instance, there's this big thing that it's caught fire in the last 10 or 12 years called heat maps. Back in the early 2000s, I saw this big movement with heat maps where specific sectors of the marketplace that were on fire. They called it. This is the hot zone. This is where everybody's trading right now. And I always thought to myself, yeah, that don't make any freaking sense. If everybody's trading that right now, I don't want to be in that. And I used the idea that I got from Larry Williams that small ranges is where you want to be paying attention, and then when it goes into big ranges, leave it alone, because that's where everybody's going to be chasing that. And I don't want to be a dog chasing a moving car, because I could end up going onto the tires, and I don't want to be ran over. I want to catch something that's getting ready to take off and be in that move. Okay, so by specifically dealing with the conditions of the marketplace or the context of what the market should be doing next, that is what smart money is doing. They're always engineering the next move. Uninformed money is always chasing what's already moving right now. And you know exactly what I'm referring to. If you've done any trading, you know exactly what I'm referring to. You know what that felt like, chasing moves. Okay. Retail sees the market as their playground. Smart money operates with a business plan because it's their market. They own the store. Okay. They know what's going to happen because it's in control by them. Now, again, this is a multi-trillion-dollar industry, and again, it is controlled, it's manipulated, and it's down to the pip. Believe me, after today, you're going to be convinced of it. Retail has, like I said, little to no knowledge of smart money, but smart money knows and conditions retail expectations. Now, retail is encapsulating large trading funds as well, because a lot of them trade with really ridiculous ideas, and it's all based on trends. Okay, they do a lot of trend-based trading. And retail, like I said, is because they're influenced by price fluctuations, smart money, therefore, manipulates price, and by doing so, the derivative of that is they manipulate the retail or small, uninformed traders. The uninformed, speculative money that are willing or unwilling are liquidity. They are taking into the marketplace to be slaughtered. Okay, we don't go into this with this idea that this is the easiest thing in the world. I'm going to make money, and there it is. No, this is very hard because it forces you to strip your expectations down to, I'm at odds with someone that does not want me here. Think about that. Contrast that with every other mentor out there. Every other mentor out there. They will frame it in a way where it feels good. It's warm and fuzzy. Let's get in here. We're going to be able to do this. We're going to be able to do that. I do not have that mindset. I know exactly who I'm in here with. Okay, I know who's in control of price. I know who that is. And when you understand what they can do and why they do what they do and when they're going to most likely do it, that gives you an edge. And then when you have that understanding, that market efficiency paradigm takes place in your own mindset, and there's a shift that completely changes the outlook on how you see the marketplace. You don't see supply and demand because that's bullshit. There's no supply and demand. None. Zero. It does not exist. It's a created invention. There is no supply or demand in currency. Okay? The central bank can print more of it anytime they want. Look at our Federal Reserve. They do it all the time. There's no supply and demand. None. There's only accumulation, distribution, and manipulation. That's it. That's all there is. And those three things happen at specific times of the day around specific criteria. We're going to actually look at that, and you can be the judge of whether or not this stuff has any merit. But I'm wagering highly that you're going to be blown away by it. Other recording, I'm not going to delete the recording because you can actually see me discussing this move here. What I was saying was that when this market dropped down like this, okay, the participants in that big, large circle of uninformed money are going to see that move drop down like that. It's going to be quick, it's going to be explosive, and they see it. It looked like this on the chart right when it happened, okay? Just go back and watch the first maybe 10 or 15 minutes of the other presentation. It's on YouTube, and there's no sound. You won't hear anything, but you can speed up the presentation speed, I think, to 2 times the delivery rate, and you can watch it go quicker. But you'll see this thing start slamming down. And my commentary was, it's going to drive down into this area here, okay? And everyone that sees that is going to want to do what? Sell it. Because they see it dropping, and they're like, well, it's dropping, so therefore I'm going to see it keep going down another 100 pips or so. Because the market makers, they drive price quickly to an area of liquidity, knowing that that fast, quick movement is going to draw excitement and attention. And if traders see that explosive, quick, reactionary move, they're all going to start talking about it. They're going to go into it. They're going to see it in their trading platforms. They're going to say, okay, well, I'm going to get in here and go short. I'm selling it right now. It's on the move. We do not see that like that at all. We don't see that at all. What we see is this low back here has stops below it, and it has liquidity resting below it. So when this thing goes down here and tags into it like it does here, okay, we know it's going to come right back up this range and go right back into this order block. That's how we have the market efficiency paradigm in activation, where we see it, we're living it, we're having it experientially, we're seeing it really manifest itself. Now, this is not a huge move. It's 50 pips or so. Big deal. But nonetheless, the same phenomenon repeats itself on all time frames. But if you see examples of like this, okay, when it comes down here and takes those stops like that, you know it's going to reach back up in this area of order block where there's going to be liquidity, okay? And right above these equal highs, what's going to be above that? Stops. So it's going to be drawn back to that and deeper inside of the order block right to the left of them, right here, okay? Inside of this range, this candle here, half of that, excuse me, half of that candle is the mean threshold. It goes right up to it. Right up into it. Okay? So, this move down here, all the way up to here, or even as far as here, is a known phenomenon. We talk about it all the time. And if you could have heard me, I was talking about it as it was happening. It really makes me mad that I couldn't capture that, but you'll see it in the video. You can actually see me actually pointing to it. It's all there. Nonetheless, it is what it is. So, I'm going to kill this part of the rant because I already spent more time with it than I wanted to. The idea of looking at the marketplace with a smart money capacity, where we see things like the banks see price. Okay, we don't look at price as a scary thing. Okay, we don't look at it as it's going to get me. Okay, I don't look at price and say, oh, it's gonna take my money today, or I'm gonna take money from the market today. I don't look at that. I don't look at the market like that. I look at where is there available liquidity right now, and is there enough time in the day for them to get that and take it someplace else. That's the bare bones of how I trade. It's simple. It's very, very simple. And I'm going to show you exactly how simple it is by incorporating what I've taught in other discussions and live sessions, True Day perspective, and what is True Day, how do we use it, and I'm going to amplify that and how we actually go into it and trade with it. So let's go over to, we'll go to that one next. Okay, here's the cable. Okay, and what we have here is the market broken down in daily format, and we have the regular day dividers here. They have the little the day labels on them. Okay, you got Friday here. Excuse me. This is Monday's trading. There's Thursday's trading. Wednesday's trading here. Tuesday's trading back here. So what we do with the concept of True Day is we don't use the dividers in the day with MT4. But if you pull up an open chart and click the Y tab or the Y letter by holding down Control, it'll give you the day dividers like this. So if I do it, I tap it, they go away. If I tap Y by holding Control down, they put the day dividers up again. When I first was looking at Forex, when I first started trading Forex, 2002, I was like, wow, this is this is a weird market. It didn't make sense to me because I was used to seeing things a little differently defined. I came from commodities, like most of you know, and I traded commodity futures contracts on the currencies. I was a real big trader with the Deutschmark before they stopped trading it. But I traded that, Canadian dollar, Australian dollar, and British pound. And I did good in Swiss franc, but then eventually it started killing me. It had really, really large gaps from the previous day's close to the next day's opening. And when you're trading the open outcry pits with session ending in the afternoon in North America, you're always going to encounter these big gaps. So I tried to take big positions, and sometimes they would gap against me at the open and eventually go back in my favor, but the gaps would kill me. So I tried to move away from doing that particular futures contract and just stayed in the lesser volatile ones like Canadian dollar, Australian, and at the time British pound was rather quiet. But the looking at how the MT4 platform divides the day, it's a little distorting. It doesn't give you the real picture. So if we're going to break down the marketplace in the way that the banks actually have their algos drive price, okay, there's got to be a frame of reference that makes sense. And if it doesn't make sense, everything that you do with price action is going to be wrong. And it's just like a cruise ship. If you're on a big cruise ship and you go up in captain's helm and you move that navigation thing by 1 degree, you may not notice it right away, but a long time down the road, you're going to be way off track. Okay, same thing happening here. If you don't know how to frame or reference the day, you'll be way off course. You have no idea how to reference what you're looking at. So I'm going to suggest to you that, we have been obviously in a market that has been bullish dollar. Okay, we moved down to an area on the dollar here. We moved into this fair value level, and here we talked about went down to a weekly order block and it's traded up, and we talked about going back up and filling in this range. Okay, it's all in live session recordings. I don't need to beat it up here. I talked about this being the most favorable event taking place. So if the dollar's going to go up, we know that there's going to be a strong likelihood to see cable and fiber go lower. So we know in other teachings that I've done on the innercircletrader.com /tutorials HTM website, you can go there and watch literally hundreds of hours of me talking about these same things that's been shared for years and years and years now by me, and nothing's changing. The only thing we're doing is delivering a lot more precision about how to apply it. By stripping down the marketplace and defining the daily range as it should be, okay, it will give you a totally different perspective on the market. Now, inside these blue little areas of shading, okay, that is defined as what I refer to as true day. Now, this is the true day to me. The true financial trading day to me is this. It's defined by 5 GMT to 20 GMT. What that means is it's basically midnight to 2 o'clock in the afternoon, New York time. Now, to avoid all kinds of confusion, me as a mentor, I've already shared my limitations and confusion with world time. Okay, I suck at that very badly. So to avoid the confusion of me messing you up, okay, the easiest thing for you to do is get yourself a little clock or a little watch, okay, and set it to New York time. And when midnight occurs at New York, see what your platform suggests that it's saying it is, and that's midnight in New York. That's the beginning of the financial day, okay? Now, I'm not talking about Wellington. I'm not talking about all that other business, 0 GMT. I'm talking about the real financial day starts at midnight in New York. Greenback is still the king. The dollar is still in control of everything else. It's the benchmark. You got to keep it in concert with everything else you're looking at. So the new day really begins Monday at midnight. So we have that delineated here. What do we do with that information? Well, it begins the financial day, and if the dollar's rallying, how do we use true day to be profitable? Well, what you do is you define it to the end, okay, or 20 GMT. That's about the last bit of the trading day that I look at for the algo. So the daily range is going to be fulfilled generally by that time. If the dollar is going higher, we're going to be looking for lower prices in fiber and cable. When do we look for the high to be formed? We've already learned in the Sniper series and precision trading concepts that the London Open generally has a 70% likelihood of making the high of the day in bearish market tones. So if you have a bearish market tone, and the context is that we're going to be seeing a lower movement across the spectrum over the daily and weekly ranges, we want to be specifically dealing with going short at London Open and potentially continuation selling in New York. Okay, and we're going to talk about that in a minute. Well, not in a minute, a couple of minutes. So the benefit of having true day on your chart like this, we can strip away all of the bullshit with this control Y 0 GMT stuff. Get that off your chart. Okay? And by having it like this, you're getting right to the brass tacks of how algos trade price. Okay, they're not trading price, they're delivering the price in a time window that is repeating over and over and over and over again. How do you exploit it? Well, this is what you do. You go in to the 5 GMT candle, okay, which is right here, and you get the opening price. Soon as that candle opens up, okay, I'm going to try to jump around a little bit and go through my notes because I'm going to get this done sooner than 3 hours this time. The opening price, as soon as that thing clicks and starts trading, you get your little mouse right over top of the candle. As soon as you get that opening price, you're in business. You're in business right now because you don't even need to wait up and sit up and trade London Open with the charts right in front of you. You don't need to do that. I promised you, Huss, that I would give you a way of trading the London session without actually having to be up watching it. And I'm going to do that now. Get up a couple minutes before midnight in New York time, okay, and you simply wait for this candle to start trading. As soon as the 5 GMT candle opens up, that opening price, that's what you note on your chart. And you draw a line right at that price, the opening price of 5 GMT or midnight, and you draw it all the way across until 20 GMT. Okay? That level, is going to be your bank trade dealers. Okay? That all this is really representing is where your bank trade deals are. When you see this level, all of the bank level trades are going to be at that level and above. Think about what I'm about to tell you, okay? We're in a market that's predisposed to go lower because the dollar's going higher, okay? If this is going lower, when is the highest probable day of the week when we would expect to see the high to form? Tuesday or Wednesday. Small likelihood on Monday, but nonetheless, the highest percentage is on Tuesday and or Wednesday. The best trading days of the week are Tuesday and Wednesday by far and large. But if we have a directional premise established on the higher time frame, the context is lower cable and fiber because of higher dollar. So we're looking for a rally up. What time of day? London. Now, I teach this principle to my children, therefore the name Judas Swing was created. But the way it was taught to me is this is actually a protraction phase in the marketplace where the algo will reach out and grab liquidity. Protraction phase. Once it reaches out and induces new liquidity or neutralizes open float liquidity, that means the trades that are actually in the marketplace that are going short, they will take those traders out. Their buy stops will be neutralized, turn into market orders to buy at the market. Smart money will be accumulating on the other side of that as counterparties or offering the sale. Why would they want to do that? Because they want to position themselves net short. You see that happening here. Once it does that, it fulfills its protraction phase. It has a specific range. We're going to teach that here. But once it fulfills it, it goes into a retractionary phase and then fills the numbers on the daily range. And we'll talk about that too as well. So in here, price will expand above the opening price at 5 GMT. It will go, well, you actually as a trader, if you don't want to sit up and wait through and watch London open, this is how you do it, okay? You get the opening price at the 12 midnight candle in New York, or 5 GMT in this case. That opening price, you draw it across your chart like this, and then what you do is you add 10 to 15 pips. This is very important. 10 to 15 pips, no more than this, okay? You add to this level. So if we're looking at this price being 141.22, 10 pips is here, 15 pips is there. You would be getting short on a limit is that right? Yeah, 141.22, 15 pips above it, 141.37. So you'd be short at 141.37. Now here's the rub. You have to take and add, if you're not going to be sitting up and watching it now, you have to add a 50 pip stop to that. Why? Because this could actually have a little bit longer protractionary phase in the marketplace and create a larger Judas swing, if you will. Okay, and you don't want to put your stop too low and get tagged out from a second run during London, because it could take a run up like this, start to trade down, and come back up one more time and take out those orders that would be right above the initial high. It's a very classic of London. What you're going to do is just once you get in here and you place your limit order, at the time you place your limit order, you put a 50 pip stop loss. Now you're probably saying, well, what the hell, Michael? You teach 30 pips. Yeah, you're right, and we're going to talk about that in a second. But 50 pips is up here, right there. Okay. Now you're not worrying about getting up and checking your phone. You're not over leveraging your account. You're going to trade like this for a month, deleveraged. If you're trading with a live account and you aren't going to listen to me trading with a demo account, trade with it deleveraged. In other words, if you only have $10,000, trade one mini lot. That's it. It's all you're going to trade, because you want to prove to yourself that this stuff is exactly what I'm telling you it is here. And trust me, it won't take you a month to see it. You'll be in your charts when this is over, going back and looking at it, and you'll be shitting yourself. So looking at this, okay, the algo at the banks will spread price open, okay, reach and seek liquidity above the marketplace. Why? Because they're injecting participants on the wrong side of the marketplace, okay, to position themselves net short, because they're going to expand the daily range in a retractionary phase where it pulls it down. That's where the intended price action is going to take it, going lower. How long is it going to go there? 20 GMT. So you have a time reference, okay? You're getting in here 10, 15 pips above the opening price at 5 GMT. There's your limit order. You add 50 pips above that. That is a no hands-on approach. Just set it and forget it. You ain't got to worry about it. You'll never, ever, ever have to worry about it. If it stops you, it stops you. If it, when you wake up at 7 o'clock in the morning in New York time, you're going to reassess everything. You're going to see, have we moved away from London? Are we lower than we were in London Open? You find the highest high in London, like here. And down in here we have, where are we at? 12 GMT, where are you at? Here we go. 12 GMT is this candle right here. So we're lower than the high that was formed in London. So we have a likelihood of range expansion still going down. Okay. Price starts to roll down, goes lower. Okay. And then runs one more time back up to this same opening price. Only goes above it by what? I think 1 or 2 pips. 2 pips it goes above it. And then look at the reaction right there. Why is it doing that? It cleared stops here. Okay. Moved back into this bearish order block. If you look at the actual body of the candle, the open on that candle is 141.24. 141.24 on this candle, the opening, which is the bottom part of the body of the candle. The high of this candle, 141.24. You can't get any better than that. It's algo driven. You can't get any better than that. It's not based on any bullshit supply and demand. It's not indicator stuff. It's just pure time and price. That's how these markets operate. There's no other definition for going into this with a state of profitability except for doing what I'm teaching you here. Okay? If you want to add all your other bullshit to it and indicators, if it lines up with what it's just doing, then great. But don't attribute it to your indicators. This is what's causing it. Okay? So you have a bank level here that they're going to key off of. Bang, it takes off, and then it shoots going lower. You can hold all the way to this candle here if it's going to be a runner. I don't do that, admittedly. I don't do that. Usually, the worst case scenario, I'm out by 1800 GMT, between 1800 and 1900 GMT. Usually, if the range expands and fills the numbers, that means it gives me the standard deviations on the central bank dealers range that I teach or will be teaching, and or the Asian range deviations that we talk about in this presentation as well. So if we have all those things met, that criteria is met, then I apply time with those levels. Okay, so when I say filling the numbers, that's what I'm referring to. It's actually coming down and going to a certain level of deviations that are created by central bank dealers range or the Asian range standard deviations that we'll show. So down here we have price making a 1700 GMT, which is noon at my New York time. Okay, that's usually the closing hour on London close for me. That candle gives you an opportunity if you get out just at the high. It's at 140.41. So 140.41 being short from 41.37 is basically 100 pips. So there's nothing wrong with doing that, and you worrying about it. We're going to go back and talk about this condition here when we talk about the Chicago Mercantile Exchange trading hours and influence over price as well. Next day here, same phenomenon. What are we looking for? Okay, we're going to get the opening price at midnight on this candle. Okay, the candle comes, the opening on that candle comes in at 139.79. We're going to take and add 10 to 15 pips to that price. And again, this is just if you want to set it and forget it, don't even worry about it. There's 10 pips, 15 pips, okay? The price right here, you're getting short at 139.94. You're going to have a 50 pip stop above it. There's your stop loss, okay? You're going to be looking to take profits when the numbers are filled. That means the central bank dealers range or Asian range standard deviations are fulfilled, which we won't be able to do here. We're going to use that as our first teaching tomorrow, because this is actually supposed to be two separate teachings today, part 1 and part 2. But we're only going to be talking about we're going to talk up to the CME pit hours influence, and then we'll stop for today. So looking at what we have another opportunity here where the trade was very profitable. It was nice. It didn't have to require you to wait around or anything to sit up, nothing like that. But the actual high of the day comes in at 7:15 GMT. That's 2:15 my time in New York. Back here, just for completeness sake, it's 8:30 GMT, which is 3:30 in the morning New York time. Okay, if you want a sweet spot for trading the high or low on London, it's going to occur generally between 8:30 in the morning and 9:30 in the morning GMT, or 2:30 in the morning to 3:30 in the morning. That's usually what you'll see it form. But when market comes down here, it actually fills the range. We'll actually talk about this tomorrow. Nails it right to the pip. And then you expect a market reversal profile to come in way on the New York session, and it does that, but then also gives it back and trades near the low of the day. Here's the low of the day. Here's the close of true range. So we have this same phenomenon that we look for Power 3, where it's an open, rally, sell it, decline, take profit near the close or the low of the day. Okay, same thing, same phenomenon here. Then we go into Thursday's trading using true day. Okay, actually it starts here if you're using 0 GMT, but we don't like to look at that time. That time of day is useless to us. Same thing here, we go into this day. Now, again, probabilities fall off precipitously for Thursday and Friday's trading when we're in a down market, especially if we had really nice Tuesday and Wednesday sell-offs. They're probably going to go in consolidation or retracement. So, even with that said, let's go into it with this mindset. We have an opportunity to be adding 10 to 15 pips above the opening price. Here's 10, 15. This is where you'd be short at. 50 pip stop loss. You never get stopped. The price does come down, gives you an opportunity to take out the lows if you know what you're looking for. Okay, if you know what you're looking for, we're going to say, honestly, we're going to say you held this trade and it moved back to the middle of the range and you took a moderate little scalp. In other words, it wasn't really that profitable to you. Okay. We can even call this a losing day if you want to. Just call it a losing day. Say you lost money on this trading day. Who cares? Bottom line is, this day was an unprofitable one. Period. We didn't make a lot of money, or we lost a little bit. Big deal. The very next day, same scenario. We go into the marketplace doing the same thing. We find the opening price, midnight candle, 10 to 15 pips. Here's 10. Here's 15. You're getting short at 140.20 institutional level. Very nice. You're going to add 50 pips to it. There's your stop. Right there. Price comes up. One more time. So this is what I was talking about. It goes up, makes a high, and then boom, you get rated out. Then it does what? It takes off. Okay? Range expands all the way down. The low of the day comes in at 1600 GMT. If I can get this thing to show. There you go, 1600 GMT. There is the profit-taking hour we talk about, 15 to 1600 GMT. 10 o'clock to 11 o'clock in the morning. That's like, to me, that's just like bread and butter, taking time, take your money and get off. And you just get out of the day, especially if it's giving you a really nice range. So, and then it moves into consolidation. Doesn't make a lower low at all. Okay? And we'll talk about how we can project these lows right down to the pip while it's trading. Now it has to trade on the other side of London. So when you start seeing my interbank algo high and low, that can only be arrived at once we close the London open session. So once 5 GMT occurs, we know where the higher lows most likely going to be for the day. That's the only thing I'm going to talk about in this presentation. But I'll actually show you where you can call the high and low within like a pip or two, based on what we'll show in this entire volume of Market Maker 12. And it's always before the hand. It's not cherry-picked hindsight bullshit like some of you guys are saying on Twitter. Trust me, you're going to shit your pants. Now looking at what we have here, same scenario here. We have today's trading. We're going to borrow this line. And we're going to put it right on the opening price or thereabouts. We're going to eyeball it. Opens 138.76. Our levels at 138.76. We're going to add 10 to 15 pips to that. So here's 10 pips right there, and 15 pips is right there. And again, this is just for guys that just don't want to be up, can't be up to watch London. You got to get up just to see what the opening price is at midnight in New York. That's all you have to do. Set your alarm, 15 minutes, go pee for your older guys that can't hold your pee. I'm becoming one of those guys, trust me, I'm not trying to make fun of you. Get up, go to the bathroom, get yourself a drink of water, check the opening price, set your orders like this. Once you understand the context of the marketplace, is it going to go higher or lower based on the higher time frame premise rather, and then you just go in, you set your stops and your limit orders. Once it trades to your price, you get short here. It runs a little bit more. You don't care. You're not watching. You're asleep. Stop loss is way up here. Price comes down, trades down into what? It sweeps an old low. Now you have to be up. You got to be up and aware of what's going on at New York Open at 7 in the morning, New York time, or 12 GMT on this platform. You got to be up around there. Now I get up around 6:30 in the morning because I just like to be up, alert, and see what's going on. Especially if I went back to sleep in London and take a nap, I got to make sure I'm awake and see what I'm doing because I've gotten in the trades half asleep and wish I never did it. So in here you have the range from this entry here and running a stop liquidity pool here. The low comes in at 138.43 and 138.91. So it's what, 50 pips again. Again, that's a week for me. 50 pips, I can build a whole week of profitability on just that. You only need 20 to double your money every single year, every single week. 20 pips a week will double your money and doing very little trading. But if you know how to really work your equity and supercharge your returns, you can do a whole lot more than that. So even when we have reactions in the marketplace where it's going back down and then we reject it and go the other way, look at the reaction you had off that same level again. Okay, we've come off of it and then swept the London high. So we have True Day giving us a context of how long we expect the range to trade out, and how do we define it? How do we stage protraction phases in the marketplace where we see Judases, where they should materialize, how we can trade them without actually being in front of our charts. We don't even have to be in there watching all this stuff as it happens. We don't need to see that. We can frame it, set it and forget it, okay, and it's done, it's handled, okay. I just gave you an opportunity on how you can paper trade or demo trade the London sessions going forward. I expect to see some feedback on this, obviously, and don't take my word for any of this. I'm not cherry picking in this. Go in any of the asset pairs that you want. It's going to be there. It's absolutely there. So let's go and look at the cable with the Chicago Mercantile Exchange pit trading hours influence. Say you guys can't trade London. Say you just can't wake your ass up to get up and check the opening price at the midnight candle. I don't know why you couldn't or wouldn't, but let's say you are one of those guys or gals. Let's go into that idea. Enter the New York Open Session. This is what you've all been missing for supercharging your New York Open Session trades. I've been an ass keeping it from you this long, but it is what it is. You have to earn these types of things. Sorry, guys. Now, looking at what we have, this is the same market, same week, same everything, okay, but now we're only focusing in on the trading hours that are associated to the trading of the futures contract. That being the British pound trading as a commodity futures contract in Chicago Mercantile Exchange. The trading hours are 7:20 a.m. to 2 o'clock p.m. Central Time. I live in Eastern Time, so that means that the times are actually going to be 8:20 a.m. to 3 o'clock in the afternoon, New York time. So with that, what we're going to do is we're going to bracket the market out just like we did the True Day, but we're just doing a smaller little window of time, and we do that beginning with 13:20 GMT. That is the same thing as 8:20 in the morning New York time, and you're going to bracket that off to 21 GMT, which is 3 o'clock in the afternoon New York time. Same trading hours dividers that you would have with the futures contract. Now, the reason why this is going to be so influential is because it's going to be highly linked to the North American trading, trading period or trading session. So if you can't be a London trader, fine. but still use the things I just described, and this will give you the framework to make your trades in New York Open supercharged and have reactions that you really would never known about without having this insight. So, same thing. We're going to go back to Tuesday. Okay, we see that London high formed. Okay, and then price comes back to that same level that we had. It was the opening price at, well, let's add it just so you can see what I'm referring to, just on this one specific one. The 5 GMT candle right here. The opening price on this candle is, good grief. Well, you just take my word for it. It's the one we just talked about just a second before we switched over to using this, and we saw it return back to here and went 2 pips above it. Okay, it does this. Okay, and it sweeps. It sweeps these highs in here, but we're going to take a closer look. This is what's going to make you shit yourself. This candle, okay, the 820 candle, that's the one you use just like at 5 GMT for New York. Okay, at 5 GMT, that's New York. In that candle, that opening price is for London Open. When you're going to be trading the New York session, you're going to be using the candle at 820 GMT or 820 New York time or 1320 GMT on this platform. If you're using Forex LTD demo account trading platform like I do when I teach, like I'm teaching here, it's going to be 1320 GMT. Basically, it's 8:20 a.m. New York time. So again, to set a clock to that time and see what that is on your platform, and that's the one you look at. Get the opening price on that. Once you have your dividers at 1320 and 2100, okay, basically 8:20 in the morning to 3 o'clock in the afternoon New York time, okay, you draw your opening price across the entire day, or at least it's divided as such. Okay, and now watch what happens. It's the same stuff I just showed you with London. What's the premise? What's the context of the market? Dollar higher, cable what? Lower. We didn't move much in terms of cable going lower. We consolidated, okay? We moved back into fair value. And we're going to talk more about that tomorrow's session. We'll actually go back into this day here too. But for now, I just want you to look at how we see the same thing happening here. The opening price on this candle is, well, I can't show you, but look in the lower right-hand corner, you'll see the opening is 141.11. If you look down here, right in here. That opening price is, oh, there it is, 141.22. Wow, where the hell did I get that 141.11 at? Did I mess that up? Yeah, 141.22. 141.22. Okay, so that's the opening on the New York candle. We went 2 pips above it with 141.24 in New York. Inside of this blue range is the pit trading hours for Chicago Mercantile Exchange for the currency markets. It's also the same trading schedule that the bond market uses, 8:20 to 3 o'clock in the afternoon New York time. We got a lot of influence there. Okay, so what we do is we look at this. I used the wrong candle. I just realized what I was doing a second ago. Opening price is 141.11. Okay, so now what you're going to do is you're going to add 10 to 15 pips. Now, again, it's New York, so you're going to have to expect lower magnitude volatility. In other words, it's not going to be as volatile as London would be. It's going to be a lot less volatile. So if you're looking to go short above 15 pips above the opening price at 5 GMT in London, you want to use 10 pips above the opening price at 8:20 on the New York session because it's going to be less volatile. So if we do that, we have price trading here. We're going to go up 10 pips. There's 10 pips right there. Ultimately, it goes up 13 pips. So you're really only 3 pips away from the high. But going short, 10 pips above the opening price at 8:20 GMT, or I'm sorry, 8:20 in the morning New York time, which is 13:20 GMT. There's your stop. I'm sorry, you're getting an entry long, okay, and you're going to put a 20 pip stop loss. Okay, 20 pip stop is what you're going to use in New York. If you want to be, and I'm not advocating this, if you want to be ultra short in terms of risk, you can do a 10 pip stop when certain conditions are met, and we'll talk more about that in this series. But for now, it's a good idea to use a 20 pip stop because you're going to fluff this up a couple different times and get real cocky with it, and then you'll get knocked out of the really good trades because you're trying to get too short with your stop. So here's your stop loss. You're in there, okay, and you're going to hold for what time of day? 15 to 1600 GMT. Here's 1645 GMT. Here's 1630. Here is 1615. And here is 1600 GMT. So my question is this: if you're getting short here, are you going to trade and hold for that? No, you can't. So you have to use the parameters that are beyond that. So what's the parameter you look for taking profits? If you've been aware of what I've been teaching all along, you know that it's the 1800 to 1900 GMT time window. Okay, that's the hour that you take for profitability on late moves in the day. So we find 1800 GMT. Here's 17. Here's 1800 GMT right there. And here's a low at 1900 GMT. Great. No, that's 1845. So anywhere in here, in time, this is where you're going to look to take profits. Only time. We are not referring to any of the central bank dealers range or the Asian range deviations that we'll use for expanding on the definition of daily range. Trust me, we're going to get to all those things that you're questioning yourself right now. Well, how do you know it's going to go in there? There's levels you look for before the fact that you'll see. Okay, but for now, if you just use average daily range, it's going to project beyond this anyway. So by itself, just know that there's a lot of room for this thing to move lower, and you would hold for specific times of the day, 18 to 1900 GMT. In this case, if that is what you're referring to when you're trade, you'd be short here. There's 1 to 1. We'll get this off. 2 to 1. 3 to 1. 4 to 1, and 5 to 1 right in here. Okay, so 5 to 1 on a New York session trade, precision oriented, based on a phenomenon that's repeatable. It does it all the time. When the context is there, just jump on it. Okay, we have the same scenario going in here. We have another setup here. Market is we used an 8:20 in the morning candle. Use the opening price. Okay, add 10 or 15 pips in here. We're going to say we did this. I wouldn't take this trade, but I'm going to say you did, just for argument's sake. You did, and you would have taken a loss on this day here. You would have taken a loss. Bottom line is, this one would still have you paid out. This one here, maybe you lost money. Maybe you didn't. Maybe you didn't take the trade, but I'm going to say you lost money. Say you took a full stop. Say you took a full 2% loss on here. Keep going. The context is still the same going into the next day. Here's the opening price. Right in here, we have, where is it at? Okay, we have 139.75, 139.75, and you add 10 to 15 pips above it. Okay, and we don't need to do that. We can see it eyeballing it. Okay, this is the New York kill zone. You can't take the trade after the New York kill zone because there's not enough time in the day. So there's no trade here. Even though it does a trade up here later in the day, it's too late for the trade to be taken. It's got to be inside the New York open kill zone. So even though we're inside this time window here, this is still, you have to use the New York session kill zone. So in other words, anything 1500 GMT past that, it falls off precipitously in terms of probability. We have another scenario here. Okay, same scenario. We're looking for lower prices. The context is higher dollar, lower cable. We have the London high back here. We have a nice move down here. This starts to run up. This is generally what you're seeing happen after 8 o'clock in the morning. You're seeing this type of move here. But this starts earlier. Here's the opening price on this candle right here, the green one. If I can get it to show up. All right, well, just use this box down here. It'll tell you the opening price when I put it on the candle. Okay, it's 139.77. 139.77. We go 10 pips above the opening price. Here's the 10 pips right here. And you could have gotten it here, maybe, maybe not. Definitely in this next candle, you'd have it. And clearly, it gives you an excellent entry because it goes back to a bearish order block here, right in here, and then boom, rejects and trades all the way down. The low of this candle comes in at 1600 GMT. That's your profit taking hour. Okay, so anyway from this candle here to here, closing the day. Also using the expansion of the daily range concepts we'll use as it relates to central bank dealers range, and Asian range deviations that we'll teach you also tomorrow morning. Basically, what I want to draw your attention to is inside of these specific areas of time, this is the same phenomenon you see going on the daily range using the this idea here, true day, where it's open, rally, sell it, down, close. Open, rally, down, down, close. Okay, it's the same phenomenon, but you're seeing it inside of a smaller segment of price. So it's fractal. So you're seeing the open, the rally, the down move, and the close on the low. It's this same phenomenon that's taking place, but you're using the specifics that are around the trading of the futures contract. The CME's trading hours of 8:20 in the morning to 3 o'clock in the afternoon New York time, they're going to manipulate price the same way they do in London for this same setup. They're going to give you this. Well, think about it. Traders have been watching it go up here, 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 here. Oh, it's going to keep going up. Well, no, it's not going to keep going up. And then boom, they take the rug right out from underneath everybody, and there it is. It's over. The influence that the CME's trading hours have is because those contracts are being traded, the spot market is going to have a great impact on those futures contracts. And because it's happening at that same time, that's why the New York Open trading can sometimes be very explosive, especially if you have the context in line, but the London Open just trades off a little bit, but in the directional premise that's intended. For instance, we see this market here, it trades up, makes the high, it trades down, and it's consolidated. So what is it doing? It's winding up for what? New York. Then New York will have that big expansion, boom, and all of the retractionary phase of the marketplace where it's moving away from the initial run up, okay, from the protractionary phase that was taking place during the Judas swing in London. They'll expand the range on the downside, filling all the numbers, which is central bank dealers range and standard deviations on the Asian range, but again, which we'll talk about tomorrow. We'll go back in these same days and show you actually everything in great detail. But for now, I just wanted to give you that. We're going to stop with this presentation because I am losing my voice. I've been basically talking for 4.5 hours now, so I'm pretty much shot my voice for today. This is the unedited version. Obviously, we're going to be doing a lot of cleanup on the week once we do all the recordings, and I'll have actual more graphics I'll put on top of these presentations, and then I'll put those links also on my website, theinnercircletrader.com, on the tutorials page. But just for sake of time delivery, like when you see these things being taught by other people, for instance, like Forex Mentor people, okay, and they say they went to work for this person and that person's bank, and they learned this and they learned that, okay, no, okay, trust me, you're going to see this stuff go out there, but it's on YouTube, it's date stamped now, okay, it's out there, you hear me talking about it, I told you people are going to take this shit and try to sell it, and they're going to try to make it their own, they're going to say something about it, that they've been doing it for 50 years, but never anyone ever's talked about this stuff before, it's never been there, okay, and what you're going to see tomorrow, trust me, it's going to blow your mind. You're going to see exactly when I say there's no reason to be afraid of price. There's no reason to fear missing a move. There's no reason to be in a rush to make a whole lot of money. Learn this stuff. Learn price action. Learn it this way, okay? If you learn this, if you understand time and price, okay, what I teach you in regards to the algos will make so much sense. All the blinders will come off. And you'll see every opportunity that you've imagined were there and just couldn't reach them, they'll be in your grasp now. And I promise you that. I'm not selling you anything except for you're going to get the understanding that you've been waiting over 5 years for this week. So with that, guys, I wish you good luck and good trading.